me or you can also type your question on the chat function here. So okay, let's welcome Black.
Awesome. All right, so I'll go ahead and share my screen. Right. All right. Can we see this? And am I in the bottom right-hand side of the screen?
Yes.
Awesome. Yeah. All right. Oh, fantastic. Thank you for the introduction. And thank you everyone for being here. I'm very excited today to talk about this paper, Catering and Return Manipulation and Private Equity. As Tianfu mentioned, I'm Blake. I'm a third-year PhD student at Florida. I do research mostly in corporate finance, but with a really strong emphasis on private markets and private equity. The paper today is joint with David Ling and Andy Naranjo, who are also from Florida and who are also here today. I don't think I'll take the full hour for the presentation, so that should leave a fair bit of time for comments and questions at the end. All right. All right. Private equity is important. If you don't believe me, here are two graphs that hopefully help convince you otherwise. On the left, I'm plotting the dollar value of commitments made to private equity funds each year for the past 20 or so years. We can see as this number has gone up a lot. In 2000, these funds, which include buyout, venture, and real estate funds, raised roughly $250 billion. Fast forward to today, these funds have raised about $1 trillion each year for the past 5 or so years. The graph on the right shows that this increase in the level is accompanied by a sharp shift in the allocation strategies of big institutional investors. So I'm plotting the fraction of US defined benefit public pension plan assets held in the same private equity funds each year for the past 20 or so years. This number has gone from about 8% to about 18.5% today over the past 20 years. However, as private equity has become increasingly important, several have raised concerns about the returns reported by the private equity fund managers. Specifically, some regulators have argued that some private equity fund managers, who I'll refer to as general partners or GPs, boost, overstate, or manipulate the returns, namely the IRRs or the internal rates of returns, that they report to their fund investors, who are referred to as limited partners or LPs. And this view makes the news quite frequently. Here's a Wall Street Journal article headline taken from last year, which reads that the SEC finds some private fund managers mislead investors on performance. Now, these concerns are especially elevated when the GPs are marketing their funds to potential investors. The PE funds themselves are closed-end limited partnerships with limited lives, meaning the GP needs to raise capital for follow-on funds for the firm to survive. A typical fund might last, say, 8 to 10 years, and if the GP does not start fund N+1 within the lifetime of that first fund, the firm won't have any funds to manage and the firm will go out of business. What this does is it at the very least creates an incentive for the GP to report higher returns in fund N while attempting to raise capital for funds number N+1. And here I'm listing several academic studies in the PE space that have looked at this incentive and thought about very carefully the extent to which GPs might react to this. Now, to visualize this a little bit further, here's a plot of the IRRs over the fund lives for the funds in our sample. The x-axis plots the age of the fund, measured as the number of quarters elapsed since the GP made its first investment or its first capital call. The y-axis plots the IRRs. The dashed line is the median, and the solid line with the circles on it is the average. What this plot shows pretty strikingly is that the IRRs are hump-shaped. What's noteworthy is that the peak of this hump occurs in roughly years 3 through 5. Now, years 3 through 5 are interesting because this is when the GP actually is marketing, or at least expected to be marketing, a follow-on fund offering to potential investors. Now, I can be a little bit more precise with this graph too. Here I've now switched the x-axis from the age of the fund to an event study-like plot where I'm looking at the IRRs of fund N around the time that fund number N+1 started. So I'm plotting the IRRs a few years before the GP completes fundraising and also a few years after the GP completes fundraising. Again, the dashed line is the median and the solid line with the circles on it is the average. And here you can see that the reported IRRs again peak pretty squarely around when the follow-on fund starts. Now, the crux of our paper really rests upon explaining why it is the case that these IRR patterns look the way that they do. A traditional explanation or traditional view of these IRR patterns might be something like the following. You could say that they're driven by opportunistic actions taken by the GPs, importantly in blue, in attempts to mislead or deceive their limited partners. In contrast, in our paper, we're going to provide evidence with a very different and alternative way of explaining these patterns, which I'll refer to as a catering view of IRR manipulations or IRR patterns. And that's this idea that they're driven by opportunistic actions taken by GPs consistent with or to cater to their investors' desires. Now, as I think I've made clear, this is a very novel way of describing these patterns and perhaps a little strange at first pass. So before going forward, I want to step back a little bit and provide some context for why we think this catering view might emerge in the first place. And to do so, I want to step back to ancient times in the year 2015. In 2015, CalPERS, one of the biggest private equity investors in the United States, and also I think the biggest public pension fund in the United States, held an investment committee meeting focused on private equity. They had a whole bunch of CIOs or chief investment officers and consultants convene at the meeting, focused on, what is the role of private equity in your portfolio? And I want to highlight the response of one very successful and prominent chief investment officer to that question. He was asked, Bob Maynard, the CIO of the Idaho Pension, was asked, what's the role of private equity in your portfolio? He responded, we did know that our actuaries and accountants would accept the smoothing that the private equity accounting would do. It may be phony happiness, bolded and in blue, but we just want to think we're happy, and they actually do have consequences for actual contribution rates we're going to be able to put in place. Now, to unpack this a little bit, what Bob Maynard is saying, or what it's implying, is it's very hard to think that LPs just simply don't do their homework. They tend to know the tips and tricks of this private equity accounting and how these returns are reported, but yet they still look at least very strange. Then he goes so far as to rationalize it, saying, hey, even though these returns are strange and we understand how they get there actually are real effects, right, reflected in contribution rates, which are no doubt of first order importance for pension funds. So what I want to do is take this phony happiness term and use it really to put a ribbon on the phenomenon that I want to capture today. I want to think about this phony happiness as the propensity for some LPs to accept or even seek out general partners that can boost or manipulate IRRs. Now, to understand why this might arise in the first place, it's helpful to think about the incentives of the allocators within the LPs that are actually choosing how much and when to commit to a fund. If these allocators receive high returns, this can benefit them in terms of several dimensions. First, you might think of this as improving their job security, both inside and outside the LP organization. It's most likely easier to have a better job if you invest in funds that report higher returns. Moreover, as Bob Maynard alluded to, higher returns can also result in higher funding ratios reflected in the contribution rates as you invest in these funds. Moreover, I don't think it's too controversial to think this, everything else equal, it would result in happier bosses, right? My boss would probably like it if I told them I have a 10% IRR, especially more so than if I told them I only have a 5% IRR. Indeed, you can kind of stitch this view together with a lot of recent literature. Here I'm highlighting quite a few papers that look at this smoothing phenomenon in many different dimensions. I want to highlight one. It's actually the only paper in this bunch which is not written strictly for an academic audience. It's from Cliff Asness, the founder of AQR, the big hedge fund. In 2019, he wrote a piece referring to private equity and its smoothing as a feature rather than a bug. More recently, he's taken to calling this phenomenon volatility laundering. Right, so with that, I think it's safe to say the test we want to conduct to look at our catering view. We can write it as follows. This catering hypothesis is the idea that GPs should manipulate returns if doing so caters to their incumbent LPs, but they should not if doing so does not. And the main result of our paper really is to provide evidence that supports this statement, which we think reflects a very different way of thinking about these IR manipulations. What I'm going to show you is that variation in catering incentives best explains variation in IR overstatement. To visualize how our results work, it's helpful to imagine a single GP right here. This GP, this general partner, may face catering incentives that are either high or are low. If they're high, we would observe that on average, the GP would tend to overstate IRRs. In contrast, if these catering incentives are low, we would observe that on average, the GP does not, or we would fail to observe that the GP overstates IRRs. So with that, I think there are roughly 4 more things that I want to do for the duration of the talk. First, I want to walk through the data. Second, I'm going to walk through how we measure IR overstatement. Then I'm going to show you how we measure catering incentives and use that explicitly to explain IR overstatement. And then I'm going to offer some explanation consistent with why we actually observe these catering incentives in the first place. Right? So our data. We're going to test for this catering using private equity real estate funds. Now, there are several characteristics of private equity real estate funds, which I think a lot of this audience is familiar with, but it's important to highlight why they're relevant for our setting when we're looking at catering relative to, say, buyout or venture funds. What's most noteworthy, I think, is that these funds typically perform pretty poorly on average. The average PERE fund in our sample has a public market equivalent, or a PME, of 0.86. What this means is for every $1 you put in a PERE fund in our sample, you would have on average earned 14 cents more had you put it in a listed benchmark. Now, this is also consistent with several other academic studies noting that this underperformance ranges from anywhere between 100 to 400 basis points per year. So it's quite sizable. Yet, despite this underperformance, PRE funds are the second largest PE asset class by commitments. In contrast, if you were to calculate this PMEs for, say, a buyout or a venture fund, you might get an estimate ranging from about 1 to 1.3, meaning that they tend to outperform their benchmarks on average by quite a bit. And again, despite this underperformance, they're the preferred mode of accessing real estate for big institutional investors such as pensions. If you're to calculate this out, for about every $1 that public pensions invest in listed real estate, you would observe $4 invested in private equity real estate funds. So we get our data from 2 sources. I'm sorry, is there someone maybe could mute themselves? There's a lot of background noise over here. No? No. All right.
That's right.
Sorry.
No.
Dave? Oh.
No.
Dave. Oh. Anyways, sorry about that. Anyways, we get our data from 2 sources, from Cambridge Associates and Preqin. From Cambridge Associates, we get 448 commercial real estate private equity funds. These funds mostly follow opportunistic value add and distress strategies, but there's a handful of core and core plus funds that remain in our sample. Then for a good chunk of these funds, we match them to the Preqin database to get a vector of the limited partners and the amount that invested in each fund and the amount that they invested in that fund. Our sample covers vintage years 2001 through 2014. In the reporting period, where I got those IRRs for the first graphs that I showed you, covers years 2006 through 2019. So here's an example. I want to be very clear, this is hypothetical and should no way imply these funds are in our sample, but here's a sample of what our data actually would look like. So we could see for, say, Blackstone Fund 5, one of the biggest PRE funds of all time, the IRR, net of fees and annualized, that are reported to date, right? So here, this is as of the first quarter of 2012, Blackstone Fund 5 reported a net of fee IRR of about 10.5%. Then for Blackstone Fund 5, we can see the vector of LPs that allocated capital to it. So from here, Blackstone received a commitment from CalPERS, one of the biggest pension funds, from the AT&T corporate pension, again, one of the biggest private sector PRE investors, and from the University of Michigan Endowment, which is the most active PRE fund investor in terms of endowments. At least that's what Preqin tells me. And then for each of these LPs, I can then see the dollar value of the commitment, where the dollar value is indexed by the position of the LP in this other vector. So CalPERS gave them $1, AT&T gave them $3, and Michigan gave them $2. Right? So with this, the first thing we do is construct some estimate of the degree of IRR overstatement in our data. And really what this test is trying to do is take those first two pictures that I showed you, the hump-shaped IRR, which coincides the fundraising, and extract the degree of overstatement from that after just taking out as many confounding factors as we can. And to do that, I want to take very seriously the idea that the fundraising event shocks the manipulation incentives of the GP. Prior to raising capital for a follow-on fund, the GP has some incentive to overstate IRRs. However, after raising capital for that follow-on fund, for Fund N+1, those incentives have at the very least gone down. And this lends itself to a very nice test that we can do. Specifically, it lets us estimate a staggered difference in differences to approximate the effect of fundraising on IRRs. So what we're doing here is comparing the IRRs among funds that have raised capital for a follow-on fund as of a given quarter to the trends in IRRs among funds that have not yet or have never raised capital for a follow-on fund as of a given quarter. Then we're going to estimate this using, among the latest and greatest in differences technology, this very nice Borusak, Haravel, and Spies imputation estimator, after including fund fixed effects, year-quarter fixed effects, and a vector of lag controls. I should emphasize, this is just our preferred specification. Most permutations, pretty much every permutation of this is perfectly reasonable too. Right? So with this test, the result really is a point estimate of the degree of overstatement. And it turns out the coefficient on this would imply that GPs overstate IRRs of about 470 basis points with a large test statistic on average around fundraising. So we can see this also in event study style plot. So on the x-axis, pardon?
I'm sorry, there is this is a little bit dated. There was a question, why are you using just 448 funds? It is supposed to be more funds during this period. Does it include non-liquidated funds?
Oh, I see. Yeah, so I'm sorry, I can't see the chat, so I apologize that I missed that question earlier. But we're using 448 funds because this is really just what CA has. We cut the vintage at 2014 to give the fund at least 5 or 7 years to raise capital for a follow-on fund. So it's not like we're just falsely assigning funds to a failed fundraising if they actually took a long time to do so. This is pretty consistent, and actually the 448 in CA, I should mention, is much larger than what we could get if we just did this in Preqin. Does that answer the question? I can't see the chat. I apologize.
Right, Blake, let me just jump in and say we also
Yeah.
exclude debt funds. We exclude funds that focus on home building. But there are some non-fully liquidated funds in the sample, but following the literature, we've given those funds up to about 7 years, I guess, 5 to 7 years to mature.
Yeah. Yeah.
So can I ask you guys a quick question?
Yeah, go for it.
So basically what you're saying is, let's say you're raising fund 3, the GP might give fund 3 investors the latest estimate for fund 2, and they might say, well, the fund 2 IRR is 15%, but you found out over the years going by the fund IRR was really 10%. Is that how I can interpret this?
Roughly, we have to, I'll explain it a little bit more on this point estimate here. It's really relative to a counterfactual constructed using pre-fundraising estimates. So if I'm going to project what it could have been based on what I observed before fundraising, I would observe that after fundraising, it's on average lower, right? So it's not one to one saying you went from 15 to 10 in terms of the reported IRR. It's saying there was a counterfactual of 15, and then what we observed was actually 10.
Right.
Does that help?
Yeah, I think it made it clear. Thanks.
Yeah.
Perfect. Were there any more in the chat that I missed?
Not at the moment. There's one more.
Oh,
there are about 1,700 funds between 2001 and 2014 in begins. I think, Dali, you want to complete your question, or you want to?
Yes, and when I check the Preqin data, there are more than 1,700 funds between 2001 and 2014, and that is in Preqin. And even if you exclude those debt funds, there are still more than 1,000. So all of those funds have the historical information. So I'm not sure why there are only 400 funds in your data. Do you include those non-liquidated funds?
Yeah, so we do include non-liquidated funds. The thing with Preqin is not all of those funds have cash flow or performance data. If I were to repeat, so the 448, maybe I wasn't clear. Those are from Cambridge Associates. From Preqin, it's about like 330 that have the full, a long enough history of IRRs to actually do something with this.
No, there are 700 funds, 1,700 funds that have performance data. What I'm reporting is performance data. If you include those, those funds.
So I'm talking about quarterly performance data, not final performance data.
Yeah, that is quarterly performance data. You can check that.
Okay, sure. We can go.
Daw, why don't you send it to us, because we subscribe to Preqin too, and we don't see what you see. So we've done this a lot, and we've compared. We have actually a paper that compares it with Cambridge, Preqin, and other data sources. And Cambridge for PERE was by far the best. Okay. Including with Burgess. I talked to people at Burgess, our former PhD student who works there, and it was far better than those other sources. So rather than go down this rabbit hole of I see something, you see something, send it to us offline and we'll clarify it.
Okay,
awesome.
Sure.
Yeah, thank you. Thank you. All right. So fantastic. So with this staggered DID, what I'm doing is I'm constructing an event study plot where the x-axis is the number of quarters to fundraising. So I'm plotting these estimated coefficients about a year before fundraising and also a few years after fundraising. We can see is that before fundraising, they're flat and virtually zero, visually consistent with the parallel trends assumption. But after fundraising, they're sharply negative and generally monotonically decreasing. So what this is saying is that the IRRs after fundraising are generally much, much lower than what they would be implied by a counterfactual using pre-fundraising data. Now, we do a bunch of tests on this to try to decompose and understand exactly what actions the GP might take such that these IRRs look the way they do. I won't talk about them too much today, but what we can show is that about 3/4 of this is ultimately explained by timing strategies in terms of the disposition that the GP makes. So things such as this quick flips idea where the GP is selling their winners and holding their losers through fundraising seems to explain a good deal about why these IRRs actually look the way they do. And in generally, this result is quite robust, as I alluded to a little bit before. Right? So with this estimate of IRR overstatement, the first thing we want to do is try to explain this in terms of catering incentives. To do so, we want to construct some measure of catering incentives, which our preferred measure is this so-called fund level investor performance sensitivity. So what I'm going to do is I'm going to walk through the formula, give an example of how this works, and then come back to the formula and explain why we think this actually does capture catering incentives. So for each fund I, we get all of the commitments from each LPJ that invested in it, divide that commitment by LPJ's AUM, sum that up, and then scale it by the number of LPs in the fund. And what this gives us is roughly the average weight of Fund I in its LPs portfolios. So an example of this here, coming back to our friend Blackstone Real Estate Fund 5, we can calculate this using the commitments that it received. So CalPERS gave Blackstone 5 $1 out of its $200 in AUM. The AT&T corporate pension gave Blackstone 5 $3 out of its $100 in AUM. And the University of Michigan endowment gave it $2 out of its $50 in AUM. We then sum these up and divide by 3 because there are 3 LPs in this fund. And what this gives us then is that on average, Blackstone 5 accounts for about exactly 2.5% of its investors' portfolios. Now 4% for the University of Michigan and 0.5% for CalPERS, but on average 2.5%. So the idea behind this measure really is just that the NPV for the GP of providing this phony happiness is more likely to be positive if a fund's returns are more important for its investors' returns. Put differently, my investors probably care a lot more about the return I report if I manage 10% of their assets than if I only manage 1% of their assets. So should there exist benefits, they're more likely to be positive and outweigh any costs if this measure is higher. So what we want to do here then is then test very simply if the evidence of overstatement is stronger among funds where the investor performance sensitivity is higher, and if it's lower among funds where this is lower. And if we calculate this out for each fund in our sample, we do have a pretty nice distribution of this fund level investor performance sensitivity. At the 25th percentile, this comes out to about 0.42%. Up to the median is about 1.33%, meaning on average, the median fund would represent 1.33% of its LPs portfolios. But up at the 75th percentile, we see some funds account for up to about 3.7, as high as about 4 or 5% of their LPs portfolios on average. So here's the test using this measure. To walk through it, I just want to focus on only the first 2 columns for now and explain how we do it. For each fund, we take the assigned investor performance sensitivity score and assign the fund as either being high or low sensitivity. High sensitivity funds are all funds where the performance sensitivity score is above the median, and low is all where it's below the median, so above or below 1.33%. Within each of these high and low sensitivity groups, we then re-estimate the staggered difference in differences, where we're looking at the effect of fundraising on the IRRs. And what we can see is that within the high group, there's strong evidence that the IRRs decline by a lot after fundraising. In contrast, in this low sensitivity group, there's virtually no evidence. So they decline by about 640 basis points in the high group, but by 110 basis points, which is not statistically significant or very economically significant, in the low sensitivity groups. As sort of a back of the envelope calculation to understand this impact for LPs, we can multiply these coefficients by a representative fund and its investors in each of the high and the low groups. So in the high group, if I multiply the 640 basis points by the 75th percentile of 3.69%, it would imply that these manipulations or these overstatements on average add about 24 basis points of IRRs for high sensitivity funds. In contrast, if I'm multiplying 110 basis points by half a percentage point, I come up with a number that's essentially 0, but to be more precise, you just say less than 1 basis point. Now, what these other columns are doing is then repeating the same test, but using different measures of AUM. So rather than using the LP's total AUM, I'm now using just their AUM in alternative assets, which would include, hedge funds, private debt, natural resources, infrastructure funds. And I'm also using just their AUM in real estate and also just their AUM in private real estate. And what this shows is, again, this very strong pattern that the IRRs tend to decline in this high sensitivity group, but not in this low sensitivity group, which indeed suggests it's not just about the idiosyncratic exposure to one asset class, but more about this total exposure or the benefits of this return to the total LP's portfolio. And I can also look at this in an event study style plot as well. So again, the x-axis is the number of quarters to fundraising, denoted about a year before to a few years after. The y-axis plots the estimated treatment effect coefficients to date. Focusing on the high group, which are the blue circles, you can see that prior to fundraising, the coefficients are virtually 0 and flat, consistent with the parallel trends assumption within this group. And then after fundraising, these coefficients are negative and decline quite sharply. In contrast, if we go to the low sensitivity group, you can see that they're flat and about 0 before fundraising. Then after fundraising, they're again flat, indicating that not much is really going on in the low sensitivity group. Most of the action is in the high sensitivity group. Now we can also do this at more granular splits. So here on your left is a graph where I've split the funds into performance sensitivity groups based on quintiles rather than just medians. So in quintile 1, these are funds that account for like 0.1% of their LP's assets. In contrast, in quintile 5, these funds might on average account for about 5 or 6% of their LP's assets. And then within each of these quintiles, I'm then recalculating the degree of IRR overstatement, or if it's higher, there's less, and if it's lower, there's more. And what you can see is in the lowest quintile, where these funds are not that important for the LP's total returns, there's really not much evidence. In contrast, you go up to quintile 5, where these funds tend to be much more important for their LP's returns. We do say that there's a lot more evidence of IRR overstatement. Indeed, this relationship is quite monotonic and works in the way that we expect it to. It's also important to note that this result really is not explained by other cross sections that we do think are quite interesting for whether the GP will or will not manipulate returns. Things such as LP past performance, or perhaps reflecting in some way the skills of the LPs that on average make these commitments, perhaps the dispersion of the LPs, perhaps reflecting the monitoring incentives that they face, or even things such as like the GP reputation, the size of the LP, the number of other funds that the GP is managing, really cannot explain the relationship between this fund level investor performance sensitivity and the observed degree of IRR overstatement. So with that, there's one more result that I want to walk through before concluding. And that's really to provide some explanation for why these catering incentives might even emerge. And I'm going to offer evidence consistent with an agency explanation for this phenomenon, but I don't mean to rule out everything else, just to say we do think this is of first order importance when explaining the catering incentives and where they arise. So to visualize the results I'm about to show, it's again helpful to think about one GP that may face high or low catering incentives. Now, this GP raised capital from a vector of LPs indexed 1 through J. Now, within each of these LP organizations, there's a CIO that committed capital to the GP. That CIO, however, has some boss. Now, the extent of the agency frictions between the boss and the CIO summarize the agency frictions within this LP. This then aggregates or passes down the vector of LPs and then aggregates up to the fund level. If these agency frictions, when aggregated at the fund level, are high, we would observe that on average, the GP would tend to overstate IRRs. In contrast, if when these agency frictions aggregated up at the fund level are low, we would fail to observe that the GP typically overstates IRRs. So to put this test in a very straightforward way, what we want to look at or say is that if manipulations are a response to agency frictions within LP organizations, then LPs with higher agency frictions are more likely to have higher return elasticities. Put differently, within the same vector of LPs, those that are making the higher commitment to a given fund should also be those that are more likely to face agency frictions should the story be correct. The challenge, of course, is that I can't just download the agency frictions of a large vector of LPs at will. Fortunately for us, though, there is a very large literature documenting that there exist a lot of agency frictions within public pension organizations. And I'm going to focus on two of them today. The first is this so-called funding ratio idea, I think brought forward very nicely in this recent RFS paper. What they argue, in part, is that LPs with lower funding ratios are more likely to face higher agency frictions. Why? Well, because if you're a pension that's less funded, it's more likely you have to go to your government and ask for more money to pay back your pension obligations, and that generally tends to be quite uncomfortable. So a way to illustrate this is, again, we can look at two LPs and think about what this test should mean for their allocation to our friend Blackstone Real Estate Fund 5. You can imagine CalSTRS, or the State Teachers Retirement System. It might be funded at, say, 83%. If this story is correct, we would then observe that it might allocate $1 out of its $100 in AUM to Blackstone 5. Conversely, say the New Jersey investment group was only funded at, say, 52%. We then observe that on average, it might commit $5 out of $100 of its AUM to Blackstone 5. But differently, within the vector of LPs, CalSTRS, the better funded LP, would have a lower return elasticity and would be dragging the total catering incentives for that GP down. We can also look at this as a second source of agency frictions, the so-called outrage risk, which is also from a very nice recent RFS paper. And this is the idea that in equilibrium, public pension boards are reluctant to compensate their CIOs at market levels because disclosing this high compensation to their plan beneficiaries might upset them, right? The CIOs are paid more than the beneficiaries, and if the board reveals that it's paying this person so much more, it might make it harder for them to get reelected on the same board. So again, to illustrate this test, it's helpful to think about two pensions that might pay their CIOs different amounts. Washington might pay their CIOs, say, $100, and we would observe then that it commits $1 out of its $100 in AUM to Blackstone 5. In contrast, maybe say the Florida State Board of Administration only pays its CIOs $80. We would then observe that it allocates, say, $5 out of its $100 in AUM to Blackstone Real Estate Fund 5. Hence, the pension that compensates its CIO less probably faces higher agency frictions, and hence this might explain its return elasticity within a given fund. And so to test this, I want to zoom to the LP commitment year level. So I'm looking the commitment each LP makes to a given fund within a given year. and see if indicators of agency frictions, these above two, the funding ratios and the outrage risk, correlate with the performance sensitivity of that individual LP. We get the data and we link it with Preqin and Cambridge Associates from two sources. The public plans database, which is readily available online, and also from FOIA requests submitted by these authors right here, Lou, Mullally, and Ray, which is available on Kevin Mullally's website. Right, so here's this test. So I'm projecting or regressing the commitment made by each LP divided by its assets on these sources of agency frictions, on the funding ratio and the pay of the CIOs, and also the pay of the CIO scaled by the average pay of its plan beneficiaries. What this shows is that pensions that are less funded within a private equity real estate fund, again, noteworthy to see there are fund fixed effect, PERE fund fixed effects here, will on average allocate more to that given fund. To interpret this, you might think that going from a 100% funded ratio to say 99% will result in a commitment of 0.33% more, 0.323% more to the same fund. And this is quite sizable. It's almost the amount of a whole commitment to another fund. And a similar story emerges if you're also looking at the pay of the CIO that made the commitment. You see that on average, when the CIOs are paid less, they will commit more to the same fund within the same fund, which is, we think, evidence consistent with an agency explanation for this catering phenomenon. So that is my last result that I want to talk through today. And now I think I'd like to conclude here. So we've done roughly 4 things. We've shown that some PERE GPs manipulate interim returns in a manner consistent with their investors' desires for such boosted returns. Why do they do this? Well, because doing so allows some LPs to report higher returns alongside lower volatility in the short term. Why might some LPs like this? Well, this phenomenon highlights the importance of some agency frictions within LP organizations. We think this view is especially pertinent since we're focusing on real estate funds and indeed consistent with some LP preference to access real estate investments through PERE funds rather than more visibly volatile marks-to-market listed real estate such as REITs. Right, so that's all that I have. I'm happy to answer any questions or discussions from here.
Okay, thank you very much, Black, for the interesting presentation. I think, Jack, you have a question, right? You raised it.
Sorry, yeah, I can't see the chat, so it's
can you can actually unmute and
Nothing in the chat.
There's nothing in the chat.
Nothing in the chat. I think
No, just it's the follow-on. We'll talk to Da offline to sort out the.
Okay, those who would like to ask any questions or comments, you can actually unmute the mic and then comments. And Jack,
yeah, hi.
Yeah.
Hi.
Jackson, can you hear me?
Yeah.
Yes.
Oh, hi, it's Jeff Hook. I actually wrote a book on private equity not too long ago.
Great.
So,
great.
I think, Jackson, what you've been describing is, with the exaggerated returns on a prior fund being used to sell a subsequent fund as securities fraud. And I was wondering, have you speculated on why the SEC or the class action attorney bar haven't focused in on this, or maybe is your paper going to alert them to this?
Yeah, so I mean, we don't, I'd be hesitant to call it purely fraudulent because, these are real IRRs. It's not like they're completely made up. I think they're potentially misleading to investors, which, I don't quite understand the full mentality of whether the LPs are actually being defrauded there. But no, I haven't and particularly thought about pushing this that way too much.
So Greg, to the extent that the LPs prefer it, they're kind of not being defrauded who's being defrauded is the end taxpayer who bears the burden. But the SEC is looking into it. I mean, that was how Blake started off his talk, with some looking into issues like this.
Yeah, I mean, the Wall Street Journal article I mentioned, that was the result of like a several-year-long SEC investigation into some of the performance reporting that the GPs do. And that's, I think it can be related.
And some of this comes about because of strategies such as selling winners early, right, to boost the initial IRRs, right? So that kind of activity is strategic. I don't think it's fraudulent. So I think we find that, Blake, you may remember the percentage, but more of this comes from sort of strategic decisions like selling winners early than it would come from, sort of just how we say, making up returns.
Yeah.
Yeah. I think 2/3 to 3/4, I think you can explain by, just saying I'm going to sell my best performing properties right before I go out to raise the next fund.
Yeah. There's Jack. Jack, you raise your hand. You'd like to your comment, Jack?
Yeah, can you hear me?
Yeah, that's right.
Yeah.
Okay. Oh, great. Okay. So, great paper. Really enjoyed understanding how you've done the analysis, and congratulations to the whole team on this, but especially you, Blake. It's a great paper.
Thank you.
So I don't know how you do a test on this, but just taking a slightly different tack than the previous questioner. We're talking about manipulating returns. We're talking about all the different ways you might be able to do that. And yet, by the time time plays out, the full Monty is known. The eventually the LP knows what the round trip fully sold off closed-end fund returns are. Now they may not during the capital raise, which is what your paper's about, which is great. And I don't know what test you would do about that, but I guess it gets to your idea that this is a catering, that they're fully aware of window dressing, they're fully aware of manipulation, they get the data eventually. And does that change behavior? I don't know what test you would do, but you must have thought about this, because the Cambridge Associates data, they subscribe to it, or they get their own LP reports. So these are GP reports. So the LPs are going to eventually know that the manipulation of return takes place. So I guess an idea I would have is it would have implications for the commitment to a subsequent fund, and not the immediate fund, but the subsequent fund. If they really thought this was bad behavior, it could show up there. But maybe you just pick up on, have you thought about testing for what I'm saying, which is that when the manipulation is discovered, is there a consequence? I think I'm hearing from your work and what you've done here is that this isn't so much about consequences. It's about almost a mutually agreed charade, if you will. So let me turn it back to you to comment.
Yeah. Well, thank you. Very, very great question. I can say I think two things that are useful here. One, a good chunk of these funds are successful fundraisers, right? I think the numbers are quite high in terms of the fraction of funds in our sample that did successfully raise a follow-on fund. So, right, all of this is conditional on getting to the next fund and so on and so forth, which would indicate that, at least on average, these funds aren't punished in terms of don't you raise the next fund. The second thing, which this is important to highlight, is particularly true for public pensions. The median tenure of a chief investment officer is only about 4 years. So what this means is that for the median CIO making this commitment, they'd be gone before the returns of the final fund are realized. So it's kind of like saying, hey, it's not my problem that it's going to collapse, it's the next person's problem. Or if I'm viewing them that they're collapsing during my tenure, oh, that was the last guy who did it, not me. So again, to me, that sort of speaks to some agency frictions between the CIO and their boss in terms of how they're choosing to actually make those commitments and perhaps interpret them within their organizations.
Yeah.
Jacques's point was a really good one, though. That is there any learning occurring? And that's a good point, which is, we looked at this a little bit, but what is the second, sort of the second subsequent fund in terms of allocations and things of that nature, right? And then if you don't see it, if they continue to allocate, that is 100% consistent with the catering piece. If they're learning, then it would say, hey, they're moving a little bit away from it, so I think we have some results there, but we could recheck them and make that point. But Jacques gave us a lot of good comments along the way. And this is another good one. So
that was fantastic.
Yeah, actually, there's the comment in the chat room. Maybe I'll let Pete to ask a question first. Pete, you have raised your hand.
Thanks. Actually, it's more 2 comments as a suggestion. So comment regarding also what Jacques was just saying. Actually, I see this kind of talk. I've been in a couple of pension fund investment advisory boards, and they're actually, we have discussion where it's actually put on paper where they say, well, the volatility is less for these private equity real estate funds because they manipulate the returns, so we don't see the volatility that much. So it's not even a secret. It's completely out there in the open. And then if I, as an external advisor, say, guys, it's completely crazy. We're actually saying that creative bookkeeping is a plus. They say, yeah, you shouldn't see it this way, blah, blah, blah. So what you're describing is really happening, and there seems to be no learning at all because they like to be manipulated. Okay, that's takeaway 1 from my rich practical expertise. Second thing, more suggestion for a paper that maybe you could quote. There's a recent paper also by Alexander Andonov and a couple of friends, also in the RFS, I think 2021, about infrastructure. And there you see exactly the same thing that you described, where the winners are sold early, and it had the idea that we have long-term commitment to capital because this is a long-term asset class. It's not happening at all. You see the same sort of behavior there in that paper that you show for real estate. So that's a good paper. Maybe you already quoted, I don't know, but it is a good paper to discuss in your lit review.
Yes, and we do quote that. That's a fantastic paper and a fantastic comment. And it's sort of striking that this sort of selling your winners thing is really concentrated in these real asset funds, which makes less sense to me than I think it should.
No, you're right. Okay, thanks.
Yes, thank you. Great comment.
Right, there's another question by Tony Azer in the chat box. Tony, do you want to just go ahead and raise it?
Okay. Maybe I'll read out the comment.
Maybe Tony left for lunch. But he has 2 comments. One, does overstatement work in the sense that it results in more successful, i.e. larger fundraise or larger funding? And I think that's kind of related to the discussion that we just had. I don't think we have any evidence that results in larger funds in terms of size, but we do, as Blake said, have evidence that it doesn't deter investors from investing in subsequent funds. And then his second comment is the equation explaining investment share has a low coefficient of determination. I suspect lots of omitted variables in that this equation could be a key to additional research.
Yes. Yeah, and
any thoughts on that?
Yeah, and that's I didn't talk about this too much, but that's part of the idea of why we thought about all these other cross sections that might be explaining, what we see, right? You might think, oh, these are just low-skilled LPs making this, they're kind of duped into doing this. That seems really inconsistent with what we find, right? You can explain variation in overstatement due to, LP past performance, for example, due to this catering thing, right? This explains most of it. If that, hopefully that's helpful. And I didn't talk about those results too much, but We did think very, very carefully for a long time about, what this measure is actually capturing and, what other omitted variables are present here and useful to think about.
So Jackson, hi, Jeff Hook again. So you may come to the conclusion that the Board of Trustees are unsophisticated and therefore rely on the chief investment officers who are kind of in cahoots with the general partners of these funds. Did you look at all at the role of consultants? Because investment consultants are sort of the gatekeepers for these big pension funds, and they unanimously support private equity and private real estate and essentially rubber stamp all these phony returns you talk about. Did you kind of look at that agency issue as well?
Yeah, and we didn't look at it particularly here, but you're exactly right. Like a lot of recent evidence on these consultants comes to the kind of disappointing conclusion that, hey, the role here is to sort of absorb responsibility for these investments, right? And I don't view that as being inconsistent with this agency idea that we talk about here.
That's a good question. Good comment.
Yeah. Yeah, we would love to have that data too.
Black, one comment on your using this AUM to sort the LP into two group, right? The high and low.
This right? Yeah.
At what point in time this AUM was mentioned? Is it at the beginnings or this a continuous?
Yeah. So the part of the challenge with the Preqin data is we have the AUM as of 2022. So that gave us some concern. So what we did is we actually went back for all of the public pensions, got their AUM in each year that they made the investment, and then repeated the test, and it's virtually the same, right? So that gives us some confidence that the cross sections we're capturing are at least not really explained by some sort of bias in the actual AUM that we get. Right, and when we do this other measure, this lets us keep, endowments and private sector pensions and sovereign wealth funds in the sample too, which we think are quite important.
Because I was thinking is whether this AUM is correlated with how long have these investors have been in the market. Those new investor probably more likely to be having a low AUM, right?
100%, right, and that's why. We thought about we even looked at the frequency of this LP's investment within that same GP. So like, have you made more than 1, 3, 5, et cetera, commitments to this GP in the past? And even that, it can't explain this variation that we're talking about.
But do you see any impacts on those LP when they exit from certain fund? Do you see that? After the exit from the fund, whether this fund performance had changed after that, especially the big LP.
So you're talking about after this fund has the LP makes a commitment.
Oh, exited maybe they exited in between before the maturity, before the end of the fund or the maturity of the fund.
So this here, the sort of back of the envelope way we think about that is this right here, right? So you think about for the LP and the high sensitivity type funds, the impact would be 24 basis points of IRRs for one fund, which is quite sizable when you think about, hey, I'm doing this for several funds at a time. In contrast, in the low group, there's really not much impact for that total LP because there's really not much manipulation and they're really not exposed to it. So it multiplies to basically 0. I see a hand here.
Yeah,
Jackless.
I was just going to what Tianfu Singh was asking about is an early exit, if I understood what you were asking, Tianfu. But so that's hard data to get. So that would be via secondary. These are closed-end funds. Everyone gets paid out at the same time. So an LP has to wait for the fund to wrap up. But a fund can, and this happened a lot in 2009, 2010, sell their interest, usually at a discount on a secondary exchange. So I don't know what that data would show you, but if there was learning, if there was penalizing, if there was a response to bad behavior or bad manipulative behavior. That would be one way it could show up, I suppose. Did you have access to that data would be my question. I'm guessing it's hard data to get.
Yeah, we don't have the secondaries data. I know of 2 papers, I think, that have that, but we don't have that. We'd also, I mean, to that point, you'd also want to know the exact terms of the contract the GP and the LP wrote, so you know whether the distribution it might expect to receive is tempered by, the share of carried interest that's going to that GP within the fund, or things like that.
Thank you.
Yeah.
Any more comments from the floor? I think it's a very interesting presentation.
Awesome.
Yes, thank you everybody for excellent comments and insights. Very, very helpful.
Right.
Thanks.
Thank you
Just
very
want to
much.
briefly advertise our talk. Next time will be on March 1st. Ron Chung will present All Economic Politics is Local, Voting Responses to Price Shocks During the Great Recession. So please join if you can.
Awesome.
Thanks to our presenters on this.
Thank you.
Thank you, everyone.
Thank you very much.
Have a good lunch. See you.
Good night. Good night.
Enjoy the water. I can't hear you. You're silent.
Do you guys want to talk, Blake and Andy?
Yeah. So why don't you, I'll have Blake come over here and we'll call in. Thank you, Tien, for hosting this event. It was great. Thank you. So Dave, I'll go offline because this is recorded. So
yep.
I'll go offline.
All right, you're gonna send me a Zoom.